There is one signal in finance that has warned us before almost every modern recession, and here is the strange part. Most investors barely glance at it. It does not come from the stock market, it does not come from the headlines. It comes quietly out of the bond market. And when it has spoken, history shows it has been worth listening to. So why does almost nobody build their thinking around it? Elena, that is exactly what we want to unpack.
Thanks, Marco. Think of this as the bond market's own alarm system, wired up by the people with the most money on the line. And that is why it matters for people like us, the everyday investor. We are not trying to trade it minute by minute. We just want to understand what the smartest, most cautious money is whispering long before it ends up on the evening news. Because by the time it is news, it is usually too late.
But here is the tension we have to sit with. A signal that good almost sounds too good to be true. Is it genuinely reliable, or has it simply been lucky a handful of times, and we have all talked ourselves into believing it? That is the honest question. Because if we are going to trust an alarm, we had better know whether it actually works, or whether we are just pattern matching after the fact. Elena, this is where it gets interesting.
And that is the whole game. Because the answer is not a simple yes or no. The real key turns out to be which version of the signal you watch, and just as importantly, when. Get that wrong, and it looks like noise. Get it right, and the track record is genuinely hard to ignore. So we are going to hand it over to the deep dive, walk through the evidence carefully, and then come back to put it all in perspective. Stay with us.
Welcome to the deep dive. We are jumping into a really fascinating stack of sources today.
Oh yeah, we've got a lot to cover.
We really do. We've pulled together a mix of academic dissertations, historical market charts, probability models straight from the New York Fed, and, a whole lot of our own research notes.
Right.
And our mission today, to unpack a single, seemingly simple line graph that happens to be the most reliable recession predictor in modern financial history.
The yield curve.
Exactly, the yield curve. And to ground this, before we even touch a single piece of financial jargon, I want you to picture a completely bizarre real-world scenario.
Yeah, I think that's the best way to understand the sheer absurdity of the math we're about to get into.
Right, so imagine you walk into your local bank, you sit down at the manager's desk, and they offer you a deal.
Okay.
You say, if you agree to lock up your money with us for 10 full years, like you cannot touch it no matter what happens in your life, we will offer you a 3% return.
Which, sounds pretty standard.
Yeah, totally normal. But then the manager leans in and says, however, if you lock your money up for only 3 months, well, we will give you 5%.
Which should instantly set off alarm bells in your head.
Exactly. I mean, why on earth would anyone accept less money for taking on vastly more time and more uncertainty?
It doesn't make sense.
Right. If my money is tied up for a decade, I'm exposed to a million unknown variables. Inflation could spike, the currency could crater, the bank could face a crisis.
Yeah, anything could happen.
Common sense dictates that I should demand a much higher reward to compensate for that long-term anxiety. Offering me less money for more risk violates every basic rule of human behavior.
And if you heard that pitch in real life, your immediate assumption would be that the bank manager made a typo.
Or they were trying to scam me.
Right, exactly. Yeah. But in the global bond market, that scenario is very real. It's not a typo. It is a highly specific phenomenon known as an inverted yield curve.
Okay, so to understand why trillions of dollars in global capital actively choose to take that seemingly terrible deal, we need to establish what normal actually looks like.
Yeah, let's build the visual for that.
And let's keep it simple, just a standard whiteboard line graph in your mind.
Perfect. So on the horizontal axis, at the bottom, the x-axis, we are plotting time. Specifically, the time to maturity of government bonds.
Okay.
You start on the far left with very short-term debt, like the 3-month government bond. As you move along that line to the right, you go further out into the future.
So that's the 2-year bond, the 10-year, all the way out to the 30-year bond.
Right. That is our timeline.
Got it. Then on the vertical axis, the y-axis, we have the yield, the actual annual interest rate percentage that the government is paying you to borrow your money.
Exactly. You plot the yield for each of those time frames, you connect the dots, and you have your yield curve. Now, in a healthy, growing economy, that curve slopes steadily upward from left to right.
Making a nice, gentle hill.
Right. The 3-month yield is low, the 2 years a bit higher, and the 10-year is much higher.
Because in a normal environment, investors operate exactly like the person in the bank. I demand extra compensation, a higher yield, to lock my money away for a decade.
Yep. The upward slope is just the visual representation of investors charging a premium for long-term risk.
That is the baseline. But an inverted curve is when that entire logic just flips upside down.
Completely. The line slopes downward.
The short-term yields on the left side of the graph physically rise above the long-term yields on the right side. You are looking at a 3-month yield paying out more than a 10-year yield.
Which brings us to the ultimate question. Why? Why are investors willingly accepting a lower yield on a 10-year bond?
Right. Because I've looked through the sources and the core realization here is incredibly counterintuitive.
It really is.
They take the 3% for a decade now because they firmly believe that in a year or two, the broader economy is going to hit a wall, and that bank will only be offering 1% or maybe nothing at all.
Exactly. They are rushing to lock in a meager long-term rate today because they are terrified of tomorrow.
Wow.
They expect broader economic growth to stall and interest rates to plummet. The downward slope is essentially the collective bond market screaming that trouble is coming.
Okay, I have to push back here for a second.
Sure.
Because understanding that investors are getting defensive makes sense in theory. But when I look at how massive and complex the global economy is, it feels strange that a single line on a graph can predict its downfall.
I get that.
How does this actually happen mechanically? Like, is there some central banker manually twisting the dials to invert this curve? Or is the free market doing this entirely on its own? It just feels too perfect to be an accident.
It isn't an accident, but it's also not a single entity pulling the strings. It is a massive financial tug of war between the central bank and the free market.
Okay, let's break down that tug of war.
Let's do it. The left side of the curve, the short end, like the 3-month bond, is heavily anchored by the central bank. When inflation is running hot, the central bank steps in to cool things down by aggressively hiking short-term interest rates.
So they are essentially throwing a wet blanket over the economy.
Exactly.
They make borrowing money very expensive, very quickly, which physically drags the left side of our graph upward.
Meanwhile, the right side of the curve, the 10-year bond, is largely out of the central bank's direct control.
Right, because that end is driven by the collective expectations of millions of investors trading in the free market.
Yes. If those investors look at the central bank hiking short-term rates and think, oh, these hikes are too aggressive, they are going to choke the life out of the economy, they will flock to the safety of the 10-year bond.
And because bond prices and yields move in opposite directions, all that massive buying pressure on the 10-year bond pushes its yield down.
You've got it. So the central bank is violently pulling the short end up to fight inflation, and the market's collective pessimism is dragging the long end down.
And when those two forces collide and the short end crosses above the long end, the curve inverts.
Right. It's the market actively betting against the central bank's ability to engineer a smooth landing.
That makes a lot of sense.
The critical takeaway is that the bond market is signaling that the current cost of money is unsustainable, and labor markets and corporate growth will inevitably break under the pressure.
And this isn't just an elegant economic theory either. When we look at the historical data in our notes, the track record is, frankly, borderline chilling.
Oh, it's undefeated.
We are specifically looking at the spread between the 10-year yield and the 3-month yield. Since the late 1960s, that specific indicator has correctly preceded 8 out of the last 8 recessions.
Yep.
8 for 8, 0 false signals.
The consistency is unmatched in macroeconomic forecasting.
I actually want to read the list of those recessions so you can feel the scale of this data.
Yeah, please do.
Because we aren't just talking about our recent history. This curve inverted before the recessions of 1969 to 70, 1973 to 75, 1980.
1981 to 82.
Right, 1990 to 91, 2001, the massive global financial crisis of 2007 to 2009, and the 2020 recession.
Every single time. The inversion was there first.
To appreciate how this became the gold standard, we really have to look at where this specific framework originated.
Right. We owe this largely to a piece of academic research by Campbell Harvey.
Yes.
It was his 1986 PhD dissertation at the University of Chicago that first explicitly linked this specific yield curve spread to future economic downturns.
It's amazing to think a grad student essentially mapped out the ultimate warning siren before the institutional titans did.
Well, he recognized something fundamental about the bond market. The bond market is dominated by massive institutional players.
Like pension funds, sovereign wealth funds, insurance companies.
Exactly. They are driven by complex mathematics and capital preservation, not retail hype. Harvey realized that the collective positioning of these institutions was far smarter and vastly more predictive than any single human forecaster or talking head.
The wisdom of the crowds, but armed with trillions of dollars and a mandate to not lose money. And reading through the sources, it's clear the establishment eventually caught on to Harvey's work. The Federal Reserve Bank of New York ended up building what is known as the Estrella-Michigan probit model.
Yes.
Which relies heavily on this exact 10-year and 3-month spread.
What makes that Estrella-Michigan model so legendary in financial circles is what it managed to outperform. It consistently beat the Commerce Department's own index of leading economic indicators.
It also beat the stock market as a predictive tool, which honestly shouldn't be surprising.
No, not at all.
The stock market is famously terrible at predicting recessions. We see it time and time again. Stocks will push to dizzying all-time highs, fueled by sheer optimism, completely ignoring the fact that the underlying economic foundation is rotting.
But the bond market, with its inherent pessimism, always seems to know.
Always.
The New York Fed actually still maintains a recession probability model based on this spread today.
Which naturally leads to the most practical question for anyone observing this data.
Okay, what is it?
If you see the line on the graph flip upside down today, should you panic tomorrow? Like, how much time do you actually have to brace for impact? Because a warning siren isn't very useful if it goes off 3 seconds before the tornado hits.
Right. Or, conversely, if it goes off 5 years in advance.
Exactly.
Well, the lag time, the window between the initial inversion and the actual economic pain, is highly variable. To see how this plays out outside of a textbook, let's walk through the timelines of the 4 most recent episodes.
Okay, let's do it.
In 1989, the curve inverted, and the recession officially began in 1990. That was a 13-month lead time.
Okay, a little over a year. That feels actionable.
Then the curve inverted again in 2000, which preceded the recession in 2001. That was also a 13-month lead.
So far, incredibly consistent.
Very. But then we get to the housing crash. The yield curve inverted in early 2006, but the massive 2008 financial crisis didn't truly hit the broader economy until late 2007 into 2008.
Wow.
That provided an agonizing 22 months of warning.
22 months. Think about the psychological torture of that for a second. Imagine being an analyst who trusts the yield curve. You see the inversion in 2006. You pull your investments, you get defensive, you warn your clients.
Yeah, you hunker down.
And then you have to sit there for almost 2 full years watching the stock market continue to climb, watching everyone around you get rich flipping houses, looking like an absolute fool before the floor finally falls out. That requires an iron stomach.
It requires immense conviction in the data. And the most recent example tests that conviction in a different way.
Oh, right, pandemic.
Yeah. The curve inverted in 2019, preceding the 2020 recession. That was only a 6-month lead. Now, the 2020 recession is widely viewed as a massive pandemic outlier because of its unique catalyst.
Yeah, a global lockdown wasn't exactly baked into the standard macroeconomic cycle.
True, but the fact remains that the mechanical signal of the inversion was perfectly intact months before the black swan event occurred.
Okay, I want to pivot slightly here because as I was digging through financial news clips and articles for this deep dive, I kept noticing a discrepancy.
Oh, about the 2-year.
Yes. We have been focusing entirely on the 10-year yield versus the 3-month yield. But half the talking heads on financial television constantly scream about the 2-year yield versus the 10-year yield. Are all these yield curve spreads created equal? Like, does it really matter which specific line you choose to look at?
It matters immensely. It's a source of constant confusion. The 10-year minus 3-month spread is the gold standard. As we noted, it boasts the 8-for-8 record with 0 false signals.
Right.
The 2-year versus 10-year spread, however, is a different beast entirely. It actually produced a false signal in 1998. It inverted, but no official U.S. recession immediately followed.
Okay, so the 3-month is reliable, but the 2-year gets faked out. But why?
Yeah.
They are both government bonds. Why would the 2-year spread trigger a false positive?
To answer that, we have to explore a deep economic subtlety known as the term premium.
Let's avoid getting bogged down in Wall Street jargon here. What exactly is the term premium in plain English?
Okay, a highly influential 2013 paper by economists Adrian, Crump, and Moenge dissected this beautifully. Put simply, the term premium is the extra compensation an investor demands strictly for the anxiety of holding a longer bond.
Okay.
It is entirely separate from their mathematical expectations of what the central bank will do with interest rates.
Ah, okay, so it's like buying hazard pay or flight insurance. My baseline mathematical expectation is that the flight arrives safely, but I'm demanding an extra premium just to soothe my anxiety over the unknown variables of the journey.
That is a perfect way to look at it. A bond's total yield is essentially two things smashed together. Your expectation of future interest rates plus that anxiety bonus, the term premium.
Gotcha.
The problem is the basic line graph we look at doesn't separate those two things. It just shows you the blended total.
And why does that blend create false signals?
Because the Adrian, Crump, and Munch paper proved that global forces can physically shrink that term premium, that anxiety bonus, for reasons that have absolutely nothing to do with a looming recession. For instance, imagine a massive influx of foreign capital. Overseas pension funds might be desperate for the perceived safety of U.S. government debt.
So they flood into the market, blindly buying up U.S. 10-year bonds, regardless of what the American domestic economy is actually doing.
Yeah.
And because of supply and demand, all that massive buying pressure artificially pushes the 10-year yield down.
Exactly. They compress the term premium. The yield curve flattens or even slightly inverts, not because a recession is imminent, but simply because there was a global scramble for safe assets.
Oh, wow. Okay.
This is why relying solely on the visual of the nominal spread, especially the 2-year and 10-year, without understanding the underlying mechanics of rate expectations versus the term premium, can lead analysts to completely misinterpret the signal.
It's like seeing a wet sidewalk and assuming it rained, without checking if someone just left their sprinklers on. You have to know the underlying cause.
Which brings us to the most dangerous part of analyzing this data.
The blind spots.
Yeah.
Because if I look at this objectively, we have a signal with an undefeated 8-for-8 track record. We understand the tug of war between the central bank and the free market. But if it is this perfect, why isn't every single fund manager using it to perfectly time the market?
Yeah, it's not a magic crystal ball.
What is the catch for someone listening to this right now?
The catch is the harsh reality of relying on economic data in real time. First, as we just saw with the historical timelines, the lead times are wildly unpredictable. The warning can arrive anywhere from 6 to 24 months in advance.
Right.
You simply cannot use a 22-month window as a precise timing tool for your personal portfolio or business decisions. The market can remain irrational far longer than you can remain solvent waiting for the recession to hit.
And even when it does hit, no one taps you on the shoulder to officially tell you. I was reading up on the National Bureau of Economic Research, the NBER.
The official referees.
Right, they're the ones who declare when the U.S. is in a recession. But they operate entirely ex post, after the fact.
They require months of revised economic data across employment, manufacturing, and income before they make a ruling. You will only be officially told you are in a recession long after the layoffs have happened and the damage is done.
Which isn't very helpful if you're trying to prepare.
Exactly. You never get real-time confirmation. Furthermore, even Campbell Harvey, the pioneer of the theory himself, actively warns against having blind faith in any single indicator.
The global economy is a complex, chaotic system. Trying to reduce the fate of billions of human transactions down to one infallible metric is a recipe for disaster.
But of all the caveats and nuances we've explored, there is one ultimate twist in the data.
Ooh, what is it?
It is a psychological trap that shatters how most people, even seasoned professionals, think about this indicator.
Okay, because the focus is almost always on the inversion. Financial news treats the inversion like the main event.
Right. But the inversion is just the siren going off in the distance, the actual trigger, the precise window when the real economic pain violently hits the labor market is usually the un-inversion.
Wait, really? The un-inversion?
Yes, it is the most counterintuitive fact of all. The un-inversion is when the curve steepens and returns to normal. The short-term rates plummet back down below the long-term rates.
So visually, the chart looks healthy again.
Exactly. Visually, it looks healthy, but economically, it is the moment of impact.
Let's break down the logic of why the return to normal is actually the trapdoor. Why does the curve un-invert?
It un-inverts because the central bank finally realizes the economy is breaking under the pressure of their high rates. Job losses are spiking, manufacturing is stalling.
So they panic.
They panic. To try and resuscitate the dying economy, they rapidly slash short-term interest rates.
And that aggressive, desperate cutting pulls the left side of our graph violently downward. The normal upward slope is restored. But the reason the slope is restored is that the house is actively on fire and the central bank is frantically spraying water on it. The steepening back to a normal shape isn't an all-clear signal. It is the ultimate confirmation that the crisis has finally arrived.
It's a harsh reality.
That is heavy, and it perfectly encapsulates why this topic is so fascinating. Let's synthesize the journey we have been on today.
Oh, good.
We started by trying to understand the bizarre, upside-down logic of a bank paying you more for short-term risk than long-term risk. We saw the flawless 8-for-8 historical record of the 10-year minus 3-month spread, tracking it all the way back to Campbell Harvey's grad school research and the New York Fed's predictive models.
We covered a lot of ground.
We really did. We explored the grueling psychological wait times from a 6-month sprint to a 22-month marathon of lag. We pushed through the jargon to understand how the term premium acts as an anxiety gauge. And finally, we uncovered the brutal psychological trap of the Un-Inversion.
It is a profound mechanism when you step back and look at it. The yield curve manages to translate the collective anxiety, the anticipation, and the pure terror of millions of market participants into a single, observable metric.
Which leaves you with a philosophical question to ponder long after you finish listening to this deep dive. Think deeply about the psychology of that Un-Inversion. The exact moment the chart finally looks like it is returning to normal, the moment the math suddenly makes sense again and the short-term rates fall back to where they belong, is actually the precise moment the economic foundation crumbles. How often in life does a sudden return to normalcy serve as the ultimate trapdoor?
Remember, this deep dive is strictly educational content, not a buy or sell recommendation. The yield curve is a framework to understand, not a prediction. Your numbers, your horizon, your risk.
So that is the picture. Not a magic crystal ball, but a pattern, a particular shape in the bond market that has shown up ahead of trouble again and again across the decades. What we hope you take away is not a number to memorize, but a way of seeing. The idea that the market quietly prices in caution before the rest of us feel it. Marco, why should someone watching right here actually care about this?
Because for an everyday investor, this is one of the few signals that gives you something precious, a little bit of lead time. It will not tell you to sell everything, and it should never be the only thing you look at. But understanding it means you are reading the same dashboard the most careful institutions read, instead of reacting to a headline after the move has already happened. That awareness alone changes how you think about risk.
And a few honest limits, because we owe you that. The timing is a range, not a date on the calendar. It points to a direction, not a precise moment. And the raw signal can sometimes be distorted by forces that have nothing to do with a downturn at all. That is exactly why you never read it in isolation, and why the deep dive walked through what to watch alongside it. Treat it as one instrument on the panel, not the whole cockpit.
So here is the bottom line. This is an analytical framework to understand the world, not an investment recommendation. The yield curve is a way of thinking, not a prediction. Your numbers, your horizon, your risk. If this helped the way you see the market, subscribe and stick with us for the rest of the series, where we take one misunderstood idea at a time and make it make sense. We will see you in the next one.